Part 2 of 3, hard money loan over here, private money loan over here. And what we're gonna look at is the real difference in your bank account at the end of this transaction, running side-by-side case studies. This is huge, guys. This is gonna shock you as I go line item by line item. I'm gonna write these numbers on the board, and what you're gonna see is something crazy happen, and I hope you guys follow along as we do this, because once you understand what I'm about to teach you in the next 10 minutes, you're gonna understand how to make money finally in this business. When I realized what I'm about to teach you in my own business, my business exploded. Before this, I struggled flipping houses for a couple years. And then I realized how to raise private money because I couldn't get my first private money lenders because I kept thinking I need to get loans at 10, 12% tops. And I passed up on 15% money. So let's look at the case study up here. 2 different lenders on the same property, same loan amount, same situation, same everything else held constant, except one is lending to you at 2 points up front, 11 points per year or per 365 days as a hard money lender or professional lender. And the other one is lending to you at 0 points up front and 15 points per year or 365 days as a private money lender. Now, the first thing we need to do is take a look at the total loan amount. We're gonna buy the house for $150,000. We're gonna put $50,000 in repairs into it. And when we sell it, we're gonna sell it for $300,000, which is not a bad price and not a bad day in the office. Now, $200,000 loan. Total, how much is it gonna take to get into that loan? Now we're gonna assume that most of the closing costs with the title company or title attorney, however you're doing it, will be the same between the two of them. But with the hard money lender, you're gonna have 2 points to originate this loan. So 2 percentage points across $200,000 is gonna be $4,000, right? This is just to get in the loan. That's $4 grand out of your pocket just to start this process. Appraisal, inspection fees, and other costs, guys, in the other video, when you watch it after this one, you're gonna see what we're talking about here. So this is $2,000. This could be a little bit more or a little bit less depending on which hard money lender you use. And yes, I know some of you guys are gonna say, well, I don't pay my hard money lender monthly. Well, that's how you do it. Most hard money lenders charge you a monthly fee, and most private money lenders do as well. Yes, some allow you to roll it to the back. I prefer it to roll it to the back, obviously also, but not all of them do. I'm talking about the most common lender. Now, here's how it's gonna look. Month 0, since we had no origination, no other costs up front, is $0 to start the private money loan. And over here, it was $6,000, $4,000 with the 2 points up front, and then all the extra fees from your appraisal, inspection fees, and so on, are the other fees to get in there that we talked about before. Now, let's take a look at what the monthly fees will be with these 2 loans. Number 1, the hard money lender over here, 11 points per year, so 11 points across $200,000 is gonna equate to $22,000 right here, but since we're calculating a monthly amount, it's going to be divided by 12, or $1,833.33. So I'm gonna take these 33 cents and flick them away because we don't need those. It's gonna confuse you guys. It's gonna be too many numbers. So we're just gonna use 1833, if that's cool with you. Now, I'm gonna put these line item by line item in a second. Now to get the monthly fee over here, for the 0.15 point, we paid nothing up front to get in the loan, which is one of the biggest reasons you want private money lenders in the first place, is limits the amount of cash you have to bring out of pocket to the deal, which increases the amount of deals that you can do. So we're gonna pay 15 points per year. That's 15 into 200,000, 15%, which would be $30,000 for the year down here. I didn't write it here, but divide by 12 is $2,500 a month. Now here's the big problem that I see out there with a lot of people in the business. They see 15% here and 11% there, and their brain naturally goes to the 11%, and they say, I'm gonna pay less. This seems more. I'm not gonna pay a 15% lender, but they never took out their calculator, because this is gonna shock you guys. Look at this as we go through here. So I took the liberty of putting $2,500 per month across 12 months. $2,500, $5,000, $7,500, and so on. Now, where's my trusty little friend over here? Here's my little notepad, because I can't think of these numbers off the top of my head, guys, so I had to write them down. Give me a second. Get ready, guys. I'm about to show you how to make some money, some real money. This is what real investors do. Number 1, this is gonna be $7,833. That's your $6,000 plus your first month of $1,833. I'm gonna add $1,833 consecutively each month after the previous one. 9,666, 11,499, 13,332, 15,165, 16,998. Now for the smart ones in the crowd, you guys see what's happening, don't you? Slow down if you don't know what I'm talking about. take a look at what's happening here. This is why one person is going to make more money and the other one's not, and we're going to compare it after this is done to time and why this actually is so important to understand and how it's really going to impact your business, guys. $16,998. So let me guys see what we're getting at. $18,831. $26,664. $22,497. $24,330. $26,163, and the last one we'll wrap it up with a nice $27,996. Okay, look at this, guys. Look at it real slow. I know some of you guys are driving. Don't drive off the road. If you're listening to this on audio, go back and watch it later. What I want to show you guys here is look at this one right here, 2 and 11 as compared to 0 and 15. It's much more expensive at certain points in the loan, isn't it? So in the beginning of the loan, it's way more expensive than starting over here. But this one would assume that it would be more expensive because you're paying 15%. But what happens as this number goes up, this number staying constant, look at what happens right around month 9. They're pretty close to equal, are they not? Okay, so they're within $3. So right around month 9, when that 9th payment's made, they're pretty much the same thing. But why is this important? When you flip a house, you should be in and out, hopefully, within 3 to 4 months, right? Now, sometimes a project takes longer because it's a bigger rehab or the market's slow or you're having mistakes. But most of the time, I'm buying a house up, fixing it up in less than 45 days and selling it in less than 45 days. I'm in and out in 3 months, hopefully not longer than 4 months. So why is this important? Let's take a look at month 8. Which one costs you more money? This one is $20,664 at month 8, and this one is $20,000. So doesn't that kind of go opposite of what most people think? The 15% loan is cheaper at month 8, but it's 15%, I'm paying 11%. This is why it's important to understand what the points up front are doing. This is why hard money lenders make it easy to get the money, because they make a lot of money off you, take a lot of your profits out of the deal, because you didn't want to take the time to go find an easy loan out there. If you guys cannot raise money at 15%, that you're not willing to go take someone who's got their money in the stock market and protect them by an equity position on the property where they're safe, and they're going to increase their interest rate up to 15% when they're already losing money with their current investment, guys, you're not trying. You're not talking to people. It is almost impossible to not raise 15% money, which is what I'm trying to get at. So what happens after the 9th month, 10th month? 2433, 25. So which one's more expensive now? So this one's more expensive going forward after this month, but before, this one is. So if you can get this transaction in, out, closed out, money in the pocket before month 8, would it be worth it to raise money at 15%, no points up front, and go out there in the marketplace to try to raise this type of money, than to just take the easy money, which is called hard money, even though it's the real easy money to get because they're all out there. You can go on the internet and Google hard money lenders in your marketplace because they're spending money to get in front of you so they can make this type of money off you. Now look down here, guys. Look at the difference in the beginning. Let's say that you are getting in and out in 3 months like I try to do. 3 months. $11,499 right here. It's $1,500 difference essentially. 3 months in. That's where a lot of mine are. Sometimes I'm not even going 3 months because we're in and out in 2-3 weeks because we're lining things up, getting in, getting out. Now take that and do that by 10 properties. It's $15,000, right? It's a lot of money. Now some of you guys, well, a big deal, it's $15,000. That's what a new investor is going to say. Those serious investors right now are saying, I know what $15,000 can do. That can get me 3 to 4 or even 5 more houses with my marketing costs in some markets that I can average $20,000 to $40,000 a house on. When you have a limited disposable income that you can't reinvest into marketing and growing your business, your deal flow is lower. This is why it's so important to not get stuck in deals and tie up all your money. So say you did 10 houses this year, you had the extra $15,000, your cost to get a deal is $5,000, you cycled that $5,000 today, and you got 3 $40,000 flip profit checks. That's $120,000 more in profit deals because you just understood a simple calculation right here, guys. This is so important. You need to understand this. So I'm putting a video out probably 2 or 3 days from now, probably Friday or Saturday if you're watching this right now live time. And we're gonna look at another lending case study because a lot of people are using joint venture partners, guys. This is one of the worst things you can do. I'm gonna show you equity financing versus debt-based financing, which one is better, why which one's better, and we're gonna use real numbers. And then if you're watching that video at that time, I'm gonna have a playlist, guys, somewhere where you can watch all three of these combined, because this is important to watch them consecutively. Say in 6 months you forget this stuff, you wanna get back into business, watch all three of these in a row. So it's a 3-part series. First one's the big difference between a hard money lender and private money lender, with a case study in the back in real numbers. And this one's just showing you, guys, go out there and raise this money. You're not asking if you're not getting this, because there's people everywhere willing to get 15% on their money. That's a good return. Most people are losing money in the stock market right now, even with how hot the stock market is. And then the last one, debt-based financing versus equity-based financing. Guys, if you like today's video, hit that thumbs up, subscribe to the channel if you could do so. I appreciate it. And I'll see you when I see you.